Okay, good afternoon, guys, and again, welcome to this afternoon's episode of accounting for non-current for long-term liabilities. Again, this is your Prof. Zeus, and we will have a continuation of our discussion on accounting for long-term liabilities. So earlier in the previous video, you've learned how to account for non-interest-bearing long-term note. Now, what if the note is long-term and it's interest-bearing? As I said earlier, two situations can occur. We have the nominal rate. This is the rate that's indicated in the promissory note. Okay, is equal to the effective rate. Or the nominal rate is not equal to the effective rate. It could either be the nominal is higher than the effective, or the effective is higher than the nominal. So what are we going to do? Now in this first situation, there's no problem. You just have to record the liability and the interest payments. Okay, no problem with that. But when it comes to this one, the nominal is not equal to the effective interest rate. We have to discount the value of the obligation. Okay? Now let's have this example on the board. So it's essentially the same example, except that number one, the nominal rate is 12%. Okay, if you look at the problem, the effective rate is 6 and the market rate is 12. Interest is payable every December 31st and principal is payable at maturity. Let us again try to draw a timeline. Okay, so here's your timeline. So this is the date of the transaction. So end of first year, end of second year, end of third year, end of fourth year. So based on our problem, principal is payable at maturity. So therefore, the principal is at here. This is the maturity date. So this is when the principal will be due and demandable and payable, 4 million pesos. But at the end of each year, the company will have to pay interest. Okay, the interest is at 12%. Okay, so what are we going to do? So let us compute for the interest expense. So that's 4 million times 0.12. That's 480,000. So this is the nominal rate. So every end of the year, we will have to pay 480,000 in the form of interest. Okay, it's 480. This is 480,000, 480, and 480,000. Okay, so now based on the timeline, we have to pay 480,000 for each of the year, okay, December 31st. Now, if you would notice now, in our timeline, we have 5 figures. One is the 4 million that is payable at maturity, and the other 4 represent the interest expense for each of the year until the maturity date. Okay? So now what are we going to do? We have to discount all of these values, okay, using the effective interest rate, which is 6%, right? Okay. Again, note that we have 480,000 as uniform from first year and the first year and to the end of the maturity of the loan, and the 4 million pesos will be at the fourth year. Okay, so here we can use the present value of 1 to discount the 4 million, and we can use the present value of annuity to discount the 480,000 per year. That is the interest. Okay, so let us do this. So you have the principal, and you have the interest. So the principal is 4 million pesos, and the interest is 480,000. So let us compute again the present value factor. 1.06 divide 1, 2, 3, 4. So that's 7920. Okay? So that's 7920. That applies to the principal. Times 0.7920. okay, minus 1 divided by 0.06. So this is times 3.4651. Okay, so we are now discounting the nominal interest, which we have computed by multiplying the principal with the nominal interest rate by the present value of annuity. Okay, so let's do this. So 4 million times 0.7920, that's again 3,168,000. And this one, it's 480,000 times 3.4651. So this is 1,663,248. So therefore, the total is 3,168. Okay, so this is 4,831,248. So this is now the present value of the obligation. Okay. Now, how much now is the principal? Principal is 4 million, sorry, pesos. So therefore, the difference is 831,248. Okay, so this is the present value of notes payable. And then this is the principal. And so therefore, this is this time it's called premium. Okay? Why? Because the present value now is higher than the principal. So this is now premium. Okay? Now again, what are we going to do? We are going to amortize the premium. Okay? So we're going to amortize the premium together with the interest expense. Okay? So again, we will now do the amortization table. Okay? Let's first do the entry at acquisition date. So therefore, debit machine. Then credit your notes payable for the principal. This is 4 million pesos. And credit your premium for 831,248. So this is 4,831,248. So that will be the entry at acquisition date. Okay? Now let us do the entry, or the amortization table. So present value is 4,831,240. Okay. And let's now do the amortization table. Okay, so you have here the date. Okay, you have the date. And then you have here the interest. Sorry. Okay, so we now have here the date, the interest expense, and then interest payment here is equal to the nominal interest. Then the amortization is the difference between the two, and then the carrying value of the obligation. So as of January 1, how much is the carrying value of the obligation? That's 4,831,248. That is the carrying value of the obligation. Okay? So therefore, on December 31, the company will have to pay 480,000 in interest. So this is 480,000. Okay, and then let's compute for the interest expense, which is equal to, again, the carrying value of the obligation multiplied by the interest, by the effective interest. So 4,831,248 times 0.06. That is 289,875. So that's 289,875 minus 480,000. So therefore, this is negative 190,125. Okay? So again, at the end of the amortization of the term of the note, this should be equal to 4 million pesos. So therefore, our amortization will decrease the obligation. So that's 4,831,248 minus 190,125. 4,641,123. Okay? Now, on the second year, so this is December 31, 2019, 2020. Okay, so therefore this is again nominal 480,000. And then for the interest expense, that's 4641 times 0.06. So that's 278,467. So therefore, minus 480,000, this will give you 1,532 or 533. So therefore, plus 533. So therefore, 4641, 123. So this is 4,439,589. Try it again. 4,341,123 minus 201,533. 590. Okay. And then December 31, 2021. Okay, times 0.06. This is 266,375. And against 480,000. So therefore, minus 480,000. This is 213,625. So that's 213,625. Okay. Deduct 4439. 590. Oh, sorry. Let us remove the negative. The parenthesis here. Sorry for that. Therefore, this is 4,225,965. Okay, and then last one, 21, 2022 times 0.06. So this is 253,579 less 480,000. So yes, 480. 253,579 less 480,000. It's 226,421. Okay. So there's a slight difference. 4,225,965 less 226,421. So there's a small difference. So we will have to adjust this one. So magkano lang? That's 4,225, no? Okay, 400, that's 456,000 difference. Okay, so this is a difference of 456,000. So we will just have to adjust. So that here, this will be 4 million pesos. So this should be 254,035. So minus 254,035 minus 480,000. 965. Okay? So this is now our amortization table for this problem. Okay? So at December 31st, what will happen is that there will be two entries corresponding to number 1, the interest that will be paid, which is equal to the nominal interest rate. And number 2 is the amortization of the premium. So for the interest expense, interest payment, debit interest expense, and credit cash. For how much? 480,000. So every December 31st, there will be an entry debiting interest expense and crediting cash for 480,000. Now the next entry would be to recognize the amortization of the premium. Okay? So what will be the entry? Debit. So number 2 entry will be debit. What will be the debit? Okay, premium on notes payable for 190,000, 125, and credit, what will be the credit? Interest expense for 190, 125. So therefore, if you would notice, a premium eventually decreases the interest expense of the company. So the question is, how much is the interest expense? Okay, the answer would be this one. Okay, which is equal to the carrying value of the obligation multiplied by the effective interest rate. Okay, so that is how you will solve this type of problem. Now let's go to letter B. Nominal interest rate is 12%. Okay, interest and principal payable every December 31st. Now in this second situation, aside from the 480,000, the principal now is payable every end of the year. Okay. And the interest, of course, will change because interest is based on the outstanding balance of the obligation. Okay? So let's do this. Okay. Again, this is the present or the date of the transaction. So date of transaction. So every year, there will be a payment to principal amounting to 1 million pesos. So this is 1 million. This is 1 and 1 M. This is 1 million. 1 million. 1 million. And 1 million pesos. So therefore, at the end of the 4th year, principal is already fully paid, right? So now let's compute for the interest. So on the first year, the outstanding obligation is 4 million. So 4 million times 0.06 0.12 pala. So 4 million times 0.12. This is 480,000. Now, at the end of the second year, the obligation is now 3 million pesos. So that will be the base, no, the principal. So 3 million times 0.12, that will be 360,000. And then, okay, at the end of the third year, or second year, then 2 million na lang yung kanyang obligation times 0.12. That's 240,000. And on the last year, so 1 million na lang yung kanyang obligation times 0.12, that's 120,000. Okay, again guys, so if you look at the timeline, okay, principal payments are uniform, 1 million each year. But the interest is not uniform. So therefore, we can use present value of annuity for the 1 million principal payments every December 31st, and then use the present value of 1 for the interest. Or we add up the 2 and then we compute for the present value using the present value of 1. Okay? Either which way, we will get the same answer. Okay? So let's go for the principal, computed using the annuity. So this is 1 million. I erase the annuity again. It's 1.06. Okay. And then for the interest, since we'll be using it, just put it on the board. So interest would be, this is 480,000 times 0.9433 Then next one, this is 360,000 times 0.8899. Then next, 240,000 0.8396. And then 120,000 multiplied by 79.7920. Okay? And then, of course, the present value of annuity, so minus 1 divided by 0.06. That's 3.4651. Okay? So, that's the computation of the, for the computation of the present value. Okay, so therefore, 1 million for the principal times 3.4651. Okay, so this is 3 million 465,100. Okay, and then 480,000 divided by 9.4933 452 784, and then 360,000 times 0.8899. That's 320,000 364, and then 240,000 times 0.8396. That's 201,000 504, and then 120,000 times 0.7920. That's 95,040. So therefore, the total of all of this is, so that's 3,465,100 plus 45278 as well. 3,465,100 plus 452,784 plus 320,364 plus 201,504 plus 95,040. So this is 4,500,000. So this is 4,524,789. So this is now the present value of the obligation. Comparing that with the principal of the obligation, which is 4 million pesos. So therefore, there's a difference of 524,789. And again, we call this premium since the present value is more than the principal. Okay? So with this one, we will now go to the amortization. Okay, you just have to follow the entries that I prepared earlier for the transaction. Okay, so therefore, let's do the amortization table. Okay, so let's do the amortization table. So we have here the date, the interest payment, interest expense, there's a payment of principal, interest expense, then we have interest payment, amortization, and then the carrying value. Again, amortization here is the difference between the two interests, the interest payment and the interest expense. Interest expense again is the carrying value of the obligation multiplied by the effective interest rate. And then the payment here is the nominal interest, okay? So therefore, at the date of transaction, that's January 1, 2019, the carrying value of the obligation is, oh, I erased it. Ang galing. Na-erase ko. Here. So this is 4,534,789. Okay? So therefore, on December 31st, 2019, there's a principal payment of 1 million. And then the interest expense is 0.06. So that's 272,087. And then the interest payment is 480,000. So again, the difference is how much? So 272,087 minus 480,000. So this is 207,913. Okay. So therefore, that's 453,4789 minus the 1 million principal payment minus 207,913. So this is 3,326,876. Okay? On December 31st, 2020, again, there's a 1 million principal payment. Now, how much is the interest expense? 0.06. So this is 199,613. Okay. And then this is 360,000. So minus 360,000. So that would be 160,387. Okay. So 3326876, 3326876 minus 1 million minus 160,387. 2,166,489. Okay. So December 31st, 2021. So again, this is 1 million pesos. And then interest expense times 0.06. So this is 129,989. And the interest payment is 240,000. So therefore the difference is, okay, minus 240,000. So this is 110,011. Okay. Plus 2,166,489. So this is 2,056,476. Okay. And then December 31, 2022. Oops, wait. Something's wrong here. Hold on. To 166,489 minus 1 million minus 110,011. So this is 1,056,478. Okay? Plus 1 million here is principal payment. Okay, times 0.06. So therefore this is 63,389. Okay? So interest payment is 120,000. So therefore the difference is 3,389. That's 120,000. So this is 56,611. Okay, so there's a difference. So what we're going to do again is adjust. Okay, we will just adjust the last year. So therefore, so this is this should be 56,478. So we will just adjust. So this should be 63,522. Okay, so this will be 0. Again, every December 31st now, there will be how many entries? Okay, there will be 3 entries. Number 1 is to recognize the payment to principal. So debit notes payable, 1 million pesos, and credit cash for 1 million. And then, we will recognize the amount of interest being paid, so debit interest expense for 480,000 on the first year, 360 on the second year, 240 on the third, and 120,000 on the fourth year. And then credit cash for the same amount, 480,000. And then another one to recognize that the amortization here.